Mahesh Nindulkar, Executive Director at CLSA, joins us from Hong Kong from the sidelines of the CLSA Asia Conference. Mahesh, fantastic to have you back. Thank you for joining us. What is your sense from meeting with investors? Do you think India is back in flavor, or there's still too much of pessimism in and around Indian equities?
My interaction with the investors here at our conference reveals that the interest clearly exists in India, but it's not that there is kind of a euphoria about the country, about the valuations, etc. The reason for that is most of the investors are a little worried about the direction of the rupee. While the currency has appreciated, but it has been quite volatile, and the markets have also been volatile. So international investors are essentially looking for more stability in both the rupee as well as some stability in the markets. So it's the volatility which is really creating some issues for foreign investors about investing in India at this point in time.
Mahesh, hi, morning. Are investors and you worried with recent tightening approach adopted by the Reserve Bank, and do you expect growth to be the collateral damage then?
I think the Reserve Bank of India has done the wise thing. On an overall basis, they have actually ended up reducing the cost of borrowing for the banking system, because while on one hand they have raised the repo rate by 25 basis points, they have also reduced the MSF by 75 basis points. So on a weighted average basis, it reduces cost of funds for the system. But clearly, the increase in the repo rate was not really anticipated, and the market has reacted negatively, for that. But I personally believe that it's the right thing to do what the RBI has done. Clearly, there was a space created by the actions of the Fed, where they kind of decided to postpone the proposed tapering, and the Reserve Bank of India has done well to take advantage of that space and tighten the rates here in India. The outlook on the growth is subdued, not just because of what the RBI has done, but also because of the other economic parameters and the fact that the government will need to reduce its spending level to meet the fiscal deficit target, and also we have been seeing higher rates in general. So the outlook on growth remains weak. Don't think it's necessarily worsened because of the recent steps by the RBI.
Mahesh, the government is trying to push stalled infra projects. Do you expect revival in the capex cycle soon, or the capex cycle will only revive after 2014 elections?
Yeah, the Cabinet Committee on Investment is really trying to speed up the stalled projects or revive the new project activity. And I think while it's a step in the right direction, I don't think we are going to have any immediate positive impact of those steps. I think it's clearly going to take at least 6 to 12 months, in my view, before we see the improvement in the capex cycle or the overall investment activities. And yes, I think elections are going to be an important factor in deciding the direction and the magnitude of investment activities going forward, because at this point in time, it's really uncertain times for the potential business investors in terms of what the election outlook is going to be. So yes, I think a more meaningful pickup will be visible only in about 6 to 12 months time from now.
RBI's 25 basis points, Mahesh, hike in monetary policy. Does that change your outlook for banking sector, and do you still continue to prefer private banks over PSUs?
We have been underweight on the banking sector in general for some time. So to that extent, the recent changes effected by the RBI doesn't really change our stance. In fact, we continue to believe that there will be more rate hikes, repo rate hikes going forward as the process of interest rate normalization happens, on the MSF side. Clearly, we believe that the private sector banks, with a strong deposit franchise, are better placed in this environment to drive the credit growth, and also better placed at handling the balance sheet pressures and the NPL pressures. So yes, we do continue to prefer select private sector banks in the space, over the PSU banks.
Mahesh, key private sector banks like ICICI, HDFC, Axis and IndusInd Bank, they have made presentations at your conference. What are the kind of sound bites you're picking up from the management of some of these banks? Are you getting a sense that the credit demand is picking up and NPA concerns have been overdone?
The feedback from the banks is clearly that of cautious optimism. There's a general belief that the recent efforts taken by the government and also what we've seen over the last 12 months in terms of the CCA activities should ultimately drive the credit demand upwards. In fact, we have seen some uptick in the credit growth numbers over the last couple of months, but that should not be confused with the economic growth revival. Because some of that credit growth numbers uptake was driven by two factors. One is the corporates are moving away to an extent from the short-term CP market and borrowing from the banks because of the short-term rates being higher, and also because of the rupee volatility. There has been a shift from foreign currency borrowing to the domestic sector as well. We continue to believe that the credit growth numbers will remain at the current subdued levels for the next 6 to 8 months, after which we can see some uptick depending upon which way the elections go, etc.
Mahesh, you like exporters. What is it that you're advising investors to take bets in IT? Because the rupee is getting stronger. Some of them have corrected from the recent highs. Would this be an entry point then?
Yeah, the rupee has gotten stronger from the recent lows. It has moved up from 69 to a dollar to almost 63 now. But our basic thesis still remains that the capital flows and the current account deficit are not going to be sufficient to drive continual uptake on the rupee. And our thesis is that yes, the current account deficit will reduce thanks to the slowing growth in the domestic markets, and also the fact that the Reserve Bank of India and the government have put some restrictions on gold imports. But we're still talking about more than $70 billion of current account deficit. And if you look at the capital inflow structure which is required for financing of the current account deficit, we note that 1/3 of the total capital inflows are attributable to the portfolio inflows from the foreign institutional investors, both in debt and equity put together. And while the tapering has been postponed for now, I don't think that we can expect the similar numbers of $25 billion a year that we used to see from the portfolio investors. So there is going to be some shortfall on the financing of current account deficit. And while there are some measures taken by the RBI, such as the FCNR deposit scheme, etc., which will probably kick the can down the line, but that will still, in our belief, not take away the pressures on the rupee completely. We do believe that rupee will continue to depreciate, therefore, and that's the reason why our preference for exporters like IT companies, that still remains.
Mahesh, your top idea at CLSA is Reliance and Tata Motors. Now, Tata Motors has done incredibly well in last 6 months, but what makes you bullish on Reliance?
So just continuing from existing themes of preferring the business models that have the natural currency hedge, both Reliance and Tata Motors qualify for that. Reliance, in our view, should also benefit from the new gas pricing policy. Although there are some question marks being raised on the applicability of it on the old fields versus the new fields, but we still believe that ultimately, Reliance will turn out to be one of the beneficiaries out of the new scheme, and we expect the EBITDA of Reliance to nearly double over the next 4 years, and that's one of the reasons why we like Reliance. For Tata Motors, clearly the business model and the earning stream is more geared towards international markets with the JLR, and we continue to expect the new launches which JLR is making will be successful. We'll get to know about the outcome of that over the next 3 to 4 months, but our positive view on Tata Motors once again is based on the expected success of its new launches and the ongoing rollout in the Chinese market.
Monsoon has been good for India this time, and that is expected to boost at least consumption as well. So how do you play consumption stocks right now, Mahesh?
Yeah, monsoon has been very good this year. In fact, it's perhaps the best monsoon that we've seen in the last decade. We expect the agri GDP growth to improve considerably from less than 2% last year to about 5% this year. That should straight away add about 40 to 45 basis points to the overall GDP growth, and also will be a positive from the rural consumption side. But yeah, as you rightly mentioned, the consumer-oriented stocks or the staples are quite expensive at this point in time. And also, while monsoon will be a favorable factor for rural consumption, don't forget the fact that the government's resolve to meet its fiscal deficit target is also going to cause a significant reduction in the government spending growth that we have been seeing. So, overall, we believe that the two factors might just offset each other out, and that's the reason why we are not too encouraged by the staples names, and we remain underweight on that space in general. Within that space, the only stock that we like is ITC because of its pricing power.
Mahesh, finally, in your recent political or in your recent take on the forthcoming elections, you've indicated a chance of election driving direction for the markets. What are you advising your clients on the same, and how exactly they should prepare their portfolios to deal with the political volatility?
Oh yeah, even historically we've seen election outcomes to have had a large impact on the overall market movements. Just to remind, after the 2004 elections, the market moved up by almost 15% over the next moved down by 15% over the next 2 days, and in 2009 the exactly reverse happened. So we do believe that the politics and the election outcome do have a large bearing on the stock market itself. And if you look at the recent election polls or the opinion polls which have been conducted by various news agencies, it looks like we are unlikely to get a very strong mandate in favor of one party or the other. So most likely it's going to be, looks like from the recent opinion polls, a case of a coalition government which will have to be dependent on several smaller regional parties, which actually will probably make the government decision making more difficult than what it is right now. So that basically leaves a big element of uncertainty in the election and politics, and that's also one of the reasons why we would stay cautious ahead of it just now.